Welcome back, everybody. Merrill Chandler here, your host of the Fundability podcast. And one of my favorite people in the universe, Mr. David Smith from FICO. And we want to show you, we're here actually in the Innovation Center at FICOWorld. Now, we've got to, we're going to pick up the entire, we're going to cut to, because it's kind of loud in here, we're going to cut to a more private venue when to do the interview. But I just wanted you guys to know that we're here, and I'm excited to be able to interview you about what's going on both here and in the SBSS world, business credit world.
Yeah, lots of changes, lots of things going on, lots of innovation in the Innovation Center. So
there's that.
We're glad to host Merrill, and I know Merrill's glad to be here. So
yeah, thrilled.
We're looking forward to a good conversation.
All right, we will cut to, we'll see you in a minute.
In the constantly changing world of fundability, the big question is this: how are entrepreneurs and real estate investors like us, ones who want to grow our businesses and who are tired of paying for really expensive alternative lending, how do we tap into the most inexpensive money available and do it without the hassle of typical borrowing? That is the question, and this podcast will give you the answers. Welcome to the Get Fundable podcast with your host, Merrill Chandler.
Welcome back, everybody. Merrill Chandler here with my one of my favorite people in all the world, and of course, my favorite person in the FICO universe, FICO lender universe, David Smith. Welcome back to the podcast.
Thank you very much. I appreciate it.
All right, as you know, we're at FICO, so there it is. The entrance. We were in there just a moment ago when we did the introduction. We wanted to come out here because it's a little quieter, and we're here to talk to kind of get an update, right? SBSS, what's happening in business lending, business borrowing, and more importantly, how the blended scores and everything that are starting to shift, and how lenders are using this blended data in order to automate underwriting, right?
Yeah. So the big trend, I mean, most of the calls that I get are based off of, hey, we need to make $100,000 loans and lower, faster, better, stronger, right? Sort of your mantra here.
Yeah.
Because the fintechs are killing them. The OnDecks, the Cabbages, they've got incredible IT investments to do automated decisioning off of all kinds of data. So the banks are saying, look, we're still working in this regulated world, this heavily regulated world. How do we do this better? And they come to us to get this SBSS score in order to use as a tool to make better, faster decisions, but not make any credit risk, not make anything riskier, right?
Right.
So the general trend is to ask for essentially name, address, serial number. I need enough information to get a personal credit report on the owners or the principals, and I need enough to go get a D&B or Experian business credit report on the business.
Right.
So, legal business name, address, phone number, gone, done.
Yeah.
And after that, if they do get cash information or, financial information, they want it from the source. They're going to go into like a Plaid or a Yodlee to go rip data out of your bank account. Because what we found with PPP, and the reason the banks are going to what we call an app only or a credit only decision, is A, it's faster, but B, that data is, I don't want to use the term reliable, but it's
more reliable.
It's credible. It's been vetted, right? There's a third party looking at it. You can contest that information if you want, but it's third party data because it's bureau data, but it's from other banks. It's from the banks that you've got credit with. And one thing we found is that the financial data that most small businesses have is frankly just not reliable.
Right.
You're a baker, you're a plumber, you're an Uber driver, you're not a CFO, right? And that matters. And that's why you need to listen to Merrill about getting your financial data in order. It really is important. But it's not important for the $50,000 loans. It's not important for the $35,000 loans. It's important for the $150,000, the $200,000, the $500,000 loans.
Right.
When you move to that next level where you need a building, you need heavy equipment, you need something, you're going to have to produce financials. But most banks are going, look, most of our business isn't in that. Most of our business is 100,000, 250 and less, right?
Right.
So how do I do this faster? And they're using your credit reports. So that's why you need to listen to Merrill about improving your credit reports, improving that data, make sure that data is clean, make sure it's effective, and it's serving you, not harming you. The second trend is really to find those small businesses. It's a little bit of marketing, a little bit of this, a little bit of that, in order to go glean these customers. One reason the fintechs dived into PPP as quickly as they did and aggressively as they did, other than the 3 to 5% fees on top of the loans, let's be honest, there's a lot of money to be made, is there was a lot of marketing to be done.
Right.
So the banks weren't serving some customers, the fintechs did. Well, now who are the businesses loyal to?
Yeah.
Businesses are loyal to the fintechs, but
Because they got approvals and they want more
they got
approvals.
the money. They survived because of this.
Right.
So, if you're dragging me onto the boat in the middle of after this big boat sinks, right? I'm loyal to you.
Yeah.
So it makes sense, but it's also costly money. So
Very expensive money. Right
Yeah.
now, 10% is easy low fintech compared to a 6 to 7%, even with the inflation rates, 6 to 7% on a small business at a bank
Yeah.
compared to 10.
10 and 10's generous. And when you factor in fees and you look at an actual APR, I mean, there's some fintechs out there doing 35 and 40% APR
The
loans.
Cabbages of the world.
I didn't name names.
I'm willing to. I'm willing to.
but they're there, right?
Right.
And that's where that they know business owners don't have a lot of time in their life, right? You don't have time to fill out a 15-page application. You don't have time to go gather data from 14 different sources and compile information and dig up your old business
For a
report
$50,000
$50,000 loan. Because when are you doing this? You're not doing this in the middle of the day when you're making money, when you're running your shop, when you're driving your truck. You're doing it at night. You're doing it when you should be sleeping, spending time with your family. Probably your spouse is asleep, the kids are asleep, even the dog's asleep, and the only light on in the room is the glow from the laptop while you complete
with your bottle of whiskey because you're so pissed
You're
off.
just regretting this. And then you look on your Google search and you say, I can get cheaper money quicker from on deck.
And it's a soft pull until you get approved.
Well, okay, that's another thing. I can't tell you how many banks have called us and said, hey, we need to start doing soft approvals. And so that's a big trend, right? And that really helps the consumer in the long run.
Because you can see, these are the terms, this is the
Right.
rate sheet. Do I pull the trigger or not?
Well, and also on the inquiry level, everybody's got a consumer credit report, or at least most small business owners do. So if you're applying for business credit and you're getting a hard hit on your consumer, so if you try to go out and get an auto loan and you've tried to apply for 5 or 6 or 7 small business loans, now you're being dinged on your FICO score because of inquiries. And they're like, wait, these two should not connect. My business and my personal should be separate. So that's why banks are moving to a more soft
pull
on
pre-approvals.
Not even pre-approvals.
Oh no, they're approving them with it.
Yeah.
You just have to get a hard pull to get all the data.
At some point, yes.
At some point.
But all the basic inquiry, it's the soft pulls. So
see, and I first of all, I love that trend. But really what we're coming to, you guys, is and what FICO, we just spent time with another individual in your work group, Glenn.
Yeah.
Glenn they're working on how to shift the overdraft modeling and how to quit penalizing individuals for use of little temporary lines and turning them into actual credit lines.
Well, yeah, because a lot of banks, they'll immediately give you, especially on a business account, and some people have them on their personal accounts, an overdraft line, right? Well, an overdraft line of credit counts as a line of credit, but it's a line of credit you can't use unless you go negative in your account. And the new FICO scores, like the FICO 10 and the FICO Ultra and the XD, they look at NSFs. So if you're going NSF on your account, that's hurting your FICO score, but
they won't give you any credit rating approvals afterwards for 6 months.
No, there's a huge circular irony in this, and
says the FICO guy.
What we're trying to convince people to do is don't give them an overdraft line. just give them a B-lock, give them a regular line of credit.
Business line of credit.
Business line of credit that can be allowed to
Use
account for the overdraft. So if you do overdraft, you have it, but also use for other things. I personally, I'm not speaking for FICO here. I can't stand, a friend of mine came to me and said, hey, I got a Goodyear credit card. And it can only be used at Goodyear. It's like, great.
every 50,000 miles,
50,000 miles
to run new
it doesn't
tires.
make sense. Well, go get a regular Visa so you can get a higher credit limit, like $2,500, and then put the $1,000 tires on that card and pay it off. But now you've got other credit you can use at the grocery store or to pay bills or to buy those fancy shoes or go on vacation, whatever you want. It doesn't make sense to get isolated things, just like the overdraft protection doesn't make sense. And so we're trying to expand that access. Plus, if you get an additional line of credit at your bank, you're going to be more loyal to that bank. So you're going to go back to them, and they're going to be in a position to know you from a credit perspective. And that 14-page application comes down to a 1-page application.
And we get,
and
after a certain amount of time where we start raising those limits, because your internal performance data is spot on, especially when we train you how to do it. You guys, my tribe knows how to do this. And then we're going to go to 5,000, 10,000,
20,000,
20,000 higher.
Exactly. So when your business matures,
you heard it here first.
When your business matures, well, that's what we're trying to do, and we've had some really good traction, but nobody's taken it yet. But a lot of good traction on it from some very large banks. So once one domino falls, they're all going to fall. So
they'll all
we really,
see that, because the data will show how valuable it is, right?
Plus, the administration is really pushing banks to do more with small businesses. There's also the contra to that side is, the more banks do with small businesses, the more the government wants to regulate small business lending. So the CFPB has a big interest in small business lending because the consumer report is part of that blended report. So expect that wave to hit the beach very, very soon. Trust me.
The tsunami is coming.
It is very, very soon.
Brilliant.
Yes, let's just say soon.
It's coming.
So yeah.
So, but it's also, for me, it's not a bad thing.
It's not necessarily a bad thing. For the banks, it's more regulation, it's additional personnel to manage things. But in reality, it's gonna put some form and structure around small business
and
lending,
more ROI on the products that they are forced to do. If they're smart borrower behaviors, then they get to profit by these very instruments.
Because there's a little bit of structure on commercial lending. There's a lot of structure on personal lending. And banks, when you fall in that intro level small business or micro business is another term,
up to $10,000 a month or something.
The banks just kick you over to a personal loan, a credit card or something, just manage that. But then again, it's that mixing of credit, which is sort of dangerous for small businesses, especially if you want to be, and I don't want to use this term, but just a legitimate business, right? If you want to not a hobbyist. Exactly. That's a very good term. If you don't want to be a hobbyist, you have to treat your credit professionally. You have to manage it professionally. You have to treat
professional borrowers.
You have to, amen to that. You've got to get an accountant or do it yourself. One or the other. Admit your faults. Admit that you're not good at something and get an accountant.
So tell them, share with them what you, as an entrepreneur, what you were doing on Fridays, and no matter what, the end of the week required this.
So I own a small business. And my wife owns a small business, and she is horrible at filling out invoices. She will wait 3 months and then fill out 3 months worth of invoices and get a huge check. But her checking account does this,
which is not good borrower behavior and doesn't attract your lender.
Exactly. So I say, look, every Friday afternoon, and this can be whatever the end of the week is for you, right? It doesn't have to be Friday. It could be Sunday. It could be Saturday. Whatever your end of the week is, you take a certain number of hours from 2 o'clock to 5 o'clock. If you're a 9 to 5er, whatever the end of your week is, take a certain set of 3 or 4 hours at the end of your week and get your finances in order. That can be invoice, bill,
catching up your books,
catching up your books. Do what it takes to prepare yourself for the next day, right? For the next week, for the next cycle. What do you need to do? Look forward. Close out last week, right? Hey, I worked with 3 clients. I did 13 hours for each client. I need to send out bills on Friday afternoon. Don't work for free. And don't upset your customer base by sending in 3 months worth of bills because they also need a cadence. They also need regularity. Everybody loves consistency.
And I'm
Be
telling you,
consistent about that.
see, the reason why I wanted to share that with you, because I love it. I'm going to incorporate that in our trainings because remember, if you're not getting regular deposits, your
Cash flow looks wonky.
It
That's
looks like
a
this.
professional term.
Yeah, wonky is not fundable.
No, it's not.
This is fundable.
Yes.
This is fundable. Even this is fundable.
Yes.
But this is
No.
not fundable.
No, that shows a lack of professionalism. It shows that you're a hobbyist. It shows you know, honestly, from a lender perspective, you're not serious about this.
Yeah.
Right. And everybody needs to act like you're serious about this, whether you're good at it or not.
Whether you're serious or
right?
not, you got to look it.
You got to look at and
Be
honestly,
serious.
know your limitations. If you're no good at this, hire an accountant. Okay. If you can't hire an accountant, talk to a friend or barter for it.
And
Give away some service for a little advice
bookkeeping.
on that.
Yes.
It's not rocket science, but it's not easy either.
Yeah.
But it takes discipline. And that's why I'm saying Friday afternoons, the end of your week, take 3 hours, get it done. Because if you wake up one day and you need widgets and you didn't order widgets and you look in the bank account and you don't have money for widgets and you don't have enough money to order widgets quickly, because quicker widgets are costly widgets, right?
Yeah.
Then you're putting yourself behind, and that's just not good. So consistency, professionalism, it's gonna grow your business more than
You are
anything.
hearing business borrower behaviors that are trackable behaviors, both in your bank accounts. It's going to end up, your P&Ls are going to be legitimate, because part of the reason why lenders want to move more and more to automatic approvals
Yeah.
is they don't trust
They
financials
can't rely on them.
anyway.
They can't rely on them. And the smaller the business, the less reliable, the more they're going to interrogate you on, hey, is this stuff true? Because they can grab tax records, but again, tax records are
They're wonky because you have a great top line. You maximize
you
top
report
line.
to the IRS, and you're not going to lie to the IRS. Please don't lie to your wife. Don't lie to the IRS. Right? It's a joke. It's a joke. Don't lie to anybody. But that's more reliable, but it's still based off that box of receipts. If you're a box of receipts person, so garbage in, garbage out. I don't care what document you put it on, it's garbage. And frankly, when you're in a regular cadence, you can say, oh yeah, I spent this $20 on a business expense. Let me roll that into the expense, so it's a write-off.
Yeah.
And you get to manage your economy within your business a little better because it's fresh on your mind. If you're waiting 2 weeks, 3 weeks, 4 weeks,
You do not
none of it's
remember.
fresh. You
Was
don't
it
remember
was
anything.
it 2 hours or 3 hours on that yard or that hair
Exactly.
or that client?
Yeah.
Right.
Yeah. How was it? And there are apps that can help you do this from a hourly management perspective. QuickBooks definitely has tips and tools in it. You can actually go to certain accounts and accountants, and they will give you, as part of their service, default reports that you can download into QuickBooks and produce reports for them. So it makes their job easier.
Yeah.
And trust me, they're not doing it just because they're friends. It's making their job easier, quicker, and cheaper. And it helps out everybody. So engage in that. Get in the habit of regular financing, and that's especially if you want to get into that larger dollar loan.
Exactly.
You
20
will-
above, 50 above, 100 above.
It's more 250. It's more 250, 100 to 250, depends on who you bank with. And also, and I'm going to say this, and I make money off very, 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 very large banks.
So listen to what he's about to say.
But I bank at a credit union. I love credit unions. I love community banks because they both sort of act in the same measure. They're
Right.
responsible for their members or their customers. They're responsible for their communities, and they have services. Believe it or not, they have services that will help the business, because if they see you failing, they're going to fail.
Right.
And they just help. So maybe look into changing banks. Maybe look into looking at smaller or regional banks. I'm not an ad service, but Renaissance Bank is a very good small business bank, and they have services for small business owners. They have ways to save. They have apps. They have connections into other systems that will help you. They've got different types of businesses that they're tied into to help their small business owners. And Bank of America probably has that, but you're going to get more advice at the community level.
Yeah,
and
more attention. And our QFE model, guys, has for client companies these tier 3 community banks, credit unions. The tier 1 and tier 2s we kind of save for the BLOCs and
and they're good. And odds are especially if you're looking at large dollar loans and you're at a credit union, you might have to go out because credit unions are kind of confined as to what they can do commercially. But again, having one or two banking relationships is not a bad thing for a business.
Exactly.
But you want a primary and a secondary, and treat the primary, treat the secondary.
Brilliant.
Yeah.
So what would you say moving into 2022, FICO's perspective? We'll close on this for just your work group, the business. Where are we headed for 2022 moving into 2023?
Yeah, we're looking for, first of all, expect some credit restrictions or constrictions. Sorry. If you're a B- credit rating, you might not get money in 2022, 2023. So BB, B+, A-. I'm not going to say it's going to constrict a lot. But it will constrict just because the economy is getting tight. We just had one negative quarter of GDP. If we go to two negative quarters, that's called a recession, and the R word's dangerous and people freak out.
Right, especially the big banks.
I mean, inflation is not pretty these days. They say it's 8%, but if you go to the Carter era calculations, it's more like 17 to 20% of what we think of as inflation. And I mean, you walk to your grocery store, walk to your gas station, and some days you have to walk to your gas station, but drive to your gas
with a gas can.
Exactly.
You ran out of gas
because you can't afford it. But there's inflation, and that's hitting everybody. It's not just the middle class, the poor, the businesses, is everybody. And so expect some constriction on the
one of the things, one of the metaphors that we use, or basically our number one symbol, is a target, right?
Yeah.
So we have the C's and the D's out in the outer rings, and then bullseye is that A+. And so we talk about fundability is driving doing a scatter shot to the. So no matter how big the target is, you're still a bullseye borrower.
And that target's going to get smaller. Expect the target to get smaller. It has to get smaller.
So get your fundability shit together,
also,
guys.
Yeah, and also if you qualify for an SBA loan, go for that. Because I don't think those loans are going to be as constricted as possible, because the
administration wants to make capital available.
They do. And it's important as you get into a recession to make more capital available to lend to businesses, because that's how you get out of a recession, right?
Yes.
So seek out SBA, loans, seek out those banks that are prominent SBA lenders. Fintechs are SBA lenders, but really go to your bank on that.
Yeah.
I'm not dissing the fintechs. I've got some really good relationships with fintechs.
He can't.
Yeah.
I do.
No,
I'm saying
I don't
build the relationship, but let's also get the traditional banks to catch up with the web banks and the neobanks and the fintechs.
A fintech should be the lender of last resort. It should not be the first place you go for money. If you have to go to them for money, go to them for money. It shouldn't be the first place. And banks are figuring that out.
Yeah. And that's what we're collaborating on every step of the way to build in a way for banks. I always position it that FICO is working towards lenders from the top down, analytics, and protect their money. We Get Fundable, Fundability Inc. is working from the bottom up, from the borrower to the lender, and improving those relationships. But really, the key to all of this is lender capacity to make right decisions and nurture relationships with borrowers.
Yeah, because right now they're only going to make sure bets. They're not gonna roll the dice on anything. The second big trend is medical debt, and I'm going to send Merrill some links. He's going to post these links and some write-ups on medical debt and what's happening with that. Basically, you don't generally ask for medical debt. You'll fill out a auto loan application. You'll fill out a credit card application. Nobody fills out a, hey, Billy broke his arm application, right? That bill comes out of nowhere, and you may or may not be expecting it, and you may or may not be able to pay for it. And frankly, your insurance may haggle, and you may owe money, and you find out after 6 months, and that debt's already in, that bill's already in collections. So there's some new regulations coming down. Again, the administration is doing some good things here. I'm not totally against them. So in July, there are going to be some changes to your credit report as to what gets counted into your FICO score and what gets on your credit report at all, around medical debt, medical collections and such. So be on the lookout for that. We
Yeah,
see
brilliant. I'll be sharing those links
Yeah.
because we're a few weeks out on publishing the podcast. I'll have
Okay.
all those links
Cool.
in the
That'll be
show
perfect
notes.
timing. Because for those people with medical debt above the limits now, you're going to see about a 25% increase in your FICO score. You're going to see some improvement because right now you're being punished for something that really wasn't your fault.
Yeah.
And frankly, with the mess that insurance and bill pay, and I don't know if you've ever been to an emergency room, you'll get a bill 4 months later from some doctor that walked by your room that decided to bill you $100.
And it's already in collections.
Yeah, it's already in collections. So it's that kind of craziness that this is addressing. So there's a change coming
Brilliant.
in July of 2022. There's a
Okay.
change coming in early 2023. And if you're using the FICO 9 or FICO 10 or 10T score, that already made some changes in medical debt.
Right.
Older scores don't, like the one Fannie and Freddie use.
542. Yeah.
Aren't using that. But the new ones do account for it. But once that data is off your credit report, then every FICO score will reflect that. And that's one of the bigger changes this year. It's what kind of
I love it.
everybody's asking about.
Yeah, I love it. Once again, first of all, it's thrilling to be here to first of all see you again.
Dude.
And
Yeah.
seriously, see you again personally. We're like brothers from different mothers because there is so much synergy, just personally,
Well, we're
professionally.
both enthusiastic about small business owners. I love small business owners and I hate to see them fail.
Yeah.
The last 2 years has just broken my heart.
Yeah,
But you can tell those that were weakened got stronger and they figured it out. So hopefully
we can keep figuring it out.
let this guy keep figuring it out for you, right? Solve the problem, solve one problem, then another problem, then another problem, and get to that fundability
Yeah,
level and get fundable.
brilliant. So
Dude,
thank you so
enjoy
much. And we have more coming to you live and from FICOWorld 2022. But again, dude,
I enjoyed
thank
it.
you so
Always
much.
do it.
Always.
Always love it.
All right, have a great day,
Bye.
and we will see you next time.
Thank you for listening to the Get Fundable podcast. Please leave comments because Merrill would love to read about your aha moments from this episode. And be sure to visit getfundable.com to read our blog, get important links, join our community, and much, much more, like ordering Merrill's tell-all book that is changing the world, The New F Word. And you got to tell your friends about this podcast because we want them to get fundable too.